Joining us now to talk about the Fed and the potential impact on the markets, Janelle Woodward, head of fixed income at BMO Asset Management, and Simeon Hyman, global investment strategist at ProShares Advisors. We'll get the equity take from Simeon. So, Janelle, not everyone is willing to say that Jay Powell has sort of mismanaged at least the way that he's presented things. There has been confusion, at least on 2 or 3 occasions, on those were kind of either rookie errors or at least not what the market wanted to hear at the time. And do you think he's gotten better now at not, a foot in mouth disease?
I think that this is the question, I think, is the Fed's move to more transparency. We've seen that move around a lot. We were transparent and we expected several increases this year, and then we were transparent and expected rates to move lower. And I think when we look at the market's reaction to the meeting in July, it's clear that we're really not trading on policy, but we're really trading on guidance. And there are a lot of questions about that, and that's what makes the speech this morning so important. And there's still a gap when we look at the minutes released earlier this week and recognize that there seems to be more consensus around this mid-cycle adjustment, but then look at a market that's expecting us to go into a full easing cycle. There's a gap to bridge here, and the Fed, in our opinion, has not handled the communication well.
Right. Inconsistency of communication. So what's the market?
That's right.
Given that we're sort of walking this fine line between easing because maybe we could use a little because of the yield curve and inflation is low. That's one reason to do it. But, the cover of the Washington Post is that Trump's economy is, what is it? There's a cloud over Trump's economy. So we hear from the president, Larry Kudlow, and others that things are great. Are things great? Why is the yield curve inverting? Why are we considering some tax cuts? Why does there seem to be some sort of foreboding about the next 12 months?
Yeah, there's definitely a delicate balance here between being too hawkish and too dovish. I think one of the other changes that we see playing out in policy is it's not just about tightening and easing. It's also about the change in stance. Historically, we've seen more counter-cyclical policy, so we're reacting to what's showing up in the data. And when we talk about insurance cuts, we've really transitioned here to make it more about pro-cyclical policy. And how do we manage that? One of our biggest concerns in here, and what if it does work? What if we need a quarter basis point, another quarter basis point to sustain the economy? When we look at where rates are, how does that persist going forward? And I think that's the risk of potentially being too dovish. And then as you highlight on the other side, too hawkish, curve is already flat, risk of inversion and recession. So it's really this delicate balance that Powell faces going into the speech this morning.
Well, when you go up in December, and then that may have been a mistake, you can't just take back a quarter because everybody assumes that when you start, there's more than one. So then you come out with, that was a mid-cycle adjustment to say maybe we only do one, and then everybody gets disappointed. I don't know. I don't know how usually an easing cycle is at least 4, isn't it?
Yeah, I think that's exactly right. And what we've seen historically is this concept of a mid-cycle adjustment just hasn't existed. And right. I think the other challenge here is independent of commentary. The last couple meetings, the Fed has given the market exactly what it wants. And that's why the gap between this commentary and focus on mid-cycle adjustment and the expectation of the market that we could see up to 4 increases over the next year is concerning. I think when we transition that, though, into portfolios and what it means from a fixed income perspective, the one thing that we are confident about is that where we were 12 months ago, concern of rising rates, negative returns of fixed income doesn't exist. And we're seeing investors more comfortable with the risk mitigation of fixed income and extending interest rate risk in portfolios.
So, Simeon, have you adjusted anything in the money you're managing in stocks based on the speech today?
The good news is that there's room for the Fed to cut, but it's not necessary.
So have you adjusted anything in your stocks in your portfolio for the speech today?
The opportunities that we see are particularly in the areas of the equity markets that have been historical beneficiaries of easing cycles.
So this is what you're doing.
Mid and small caps are now at a 35% discount to large. They were at parity just 5 years ago. In emerging markets, too. The malaise in Europe is likely to persist long after the trade wars are done. But emerging markets have been a historical beneficiary of easing. So, those are pockets of opportunity. But you just have to be careful because there is some weakness. Capacity utilization has dropped to 77%, which doesn't sound like a lot, but it was near 80 at the beginning of the year. I'll tell you one weird, interesting bright spot in the economy right now. The Baltic Dry Index is triple what it was a year ago. About half of that is for regulatory reasons, but not all of it. So there are some green shoots.
The fact that small caps, I mean, we're not talking about a short-term thing. Now, this has been going on for years and years and years and years. Why the chronic underperformance? When is that ever going to turn?
Well, there's a lot of junk in small caps. That's the challenge. 40% of the companies in the Russell 2000 don't make any money. So that becomes a challenge, particularly if earnings growth is even harder to come by. So, the prudent move is to go smaller in cap, but stay on the quality side.